studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that sunk he died.
Up to this point, we've learned how to calculate Capital Cost Allowance, or CCA, and we've also learned how non-capital losses can be carried back to recover taxes paid in previous years. Now we arrive at one of the most important concepts in corporate tax planning. Just because a deduction is available doesn't mean you should automatically claim it. Many beginners believe the goal of tax preparation is to claim every deduction possible. Professional accountants think differently. Their objective is not to maximize deductions today, it is to maximize total tax savings over the life of the business. Let's consider a corporation that has already incurred a business loss during the current year. The corporation also owns depreciable assets, such as a delivery van, production equipment, and computers. Since these assets qualify for capital cost allowance, the corporation has a choice to make. The first option is to claim CCA this year. Claiming CCA increases the current year's deductions, which creates an even larger non-capital loss. A larger loss may allow the corporation to carry back more of that loss to previous profitable years and potentially receive a larger tax refund from the CRA. The second option is not to claim CCA. Remember that claiming CCA is generally discretionary. A corporation is not required to claim the maximum amount each year. Instead, it can leave some or all of the available CCA unclaimed. Those unused deductions remain available for future years when the corporation returns to profitability. This is where tax planning begins. The accountant must ask an important question. Will claiming CC today produce the greatest overall tax benefit? Or would it be better to preserve that deduction for a future year when the corporation may have taxable income to offset? The correct answer depends on the corporation's circumstances. If the corporation needs immediate cash and can recover taxes through a loss carryback, claiming more CCA may be beneficial. On the other hand, if the business expects strong profits in future years, preserving CCA could provide larger tax savings later. Professional tax planning is about evaluating alternatives rather than following the same approach every year. Every deduction should support the corporation's overall financial and tax strategy. The key takeaway from this slide is simple but extremely important. Tax deductions should be optimized, not automatically maximized. The best tax decision is the one that creates the greatest long-term benefit for the corporation, not necessarily the largest deduction in the current year. Now, let's compare the two possible tax strategies side by side. Remember, both strategies are perfectly acceptable under Canadian tax law. The question is not which one is correct, but which one creates the greatest overall tax benefit for the corporation. Let's begin with the first strategy, claiming capital cost allowance today. Suppose the corporation already has a business loss for the current year. If it also claims CCA on its depreciable assets, the current year's deductions increase even further. As a result, the corporation generates a larger non-capital loss. A larger loss may be extremely valuable if the corporation earned taxable profits and paid taxes in previous years. By carrying back the larger loss through Schedule 4, the corporation can offset more prior year taxable income and receive a larger tax refund from the Canada Revenue Agency. This approach offers several advantages. It provides immediate tax savings, generates a larger refund, and improves short-term cash flow. For businesses that need additional cash today, this can be a very attractive option. Now let's look at the second strategy, saving the available CCA for later. Instead of claiming CCA this year, the corporation deliberately leaves some or all of its available deduction unclaimed. Since CCA is generally optional, The unused amount remains available in the asset's undepreciated capital cost balance for future years. By preserving CCA, the corporation creates a smaller current year loss, but it also keeps valuable deductions available for future profitable years. When the business begins earning taxable income again, those saved deductions can reduce future taxes. This strategy also has important advantages. It provides greater flexibility, allows larger deductions in future years, and supports long-term tax planning. In some situations, preserving CCA can generate greater overall tax savings than claiming it immediately. Notice the balance scale in the middle of the slide. On one side is money today through a larger carryback refund. On the other side is money tomorrow through future tax savings. Professional accountants evaluate both options before making a recommendation. The decision depends on several factors. They consider the corporation's expected future profitability, current and future corporate tax rates, available losses, and cash flow requirements. Every business is different, so the optimal strategy may also be different. This is why there is no single correct answer. The best choice is the one that maximizes the corporation's total tax savings over time, not simply the largest deduction in the current year. The key takeaway from this slide is that tax planning is about comparing alternatives. Whether the corporation claims CCA today or preserves it for later, the goal is always the same. Choose the strategy that creates the greatest overall financial benefit for the business. This slide brings everything together by showing how professional tax advisors make strategic decisions. Preparing a corporate tax return is more than completing forms and calculating numbers. It also involves evaluating different options and choosing the one that delivers the greatest overall benefit for the corporation. The decision-making process begins with the corporation's current year business loss. Once the loss has been calculated, the accountant starts asking a series of important questions rather than immediately claiming every available deduction. The first question is simple. Does the corporation need immediate cash? If the answer is yes, then recovering taxes paid in previous years may become the highest priority. In that situation, claiming available capital cost allowance can increase the current year's non-capital loss. A larger loss can then be carried back through Schedule 4 to prior profitable years, resulting in a larger tax refund from the Canada Revenue Agency. This approach is especially valuable for businesses that need additional cash flow. Receiving a tax refund today can provide working capital that helps support ongoing operations or future investments. But suppose immediate cash is not the corporation's primary concern. The accountant then asks a second question. Is the corporation expected to earn taxable profits in future years? If the answer is yes, preserving some or all of the available CCA may be the better strategy. By choosing not to claim the deduction today, the corporation keeps that tax deduction available for future years when it can offset future taxable income. This can reduce taxes when the business becomes profitable again and may generate greater long-term tax savings. If the future outlook is uncertain, the accountant may evaluate additional planning opportunities. These could include the timing of income and expenses, the use of other available deductions, or broader tax planning strategies that better match the corporation's financial goals. Notice the checklist on the right side of the slide. Professional accountants consider many different factors before making a recommendation. They evaluate the size of the current year's loss, expected future profitability, the corporation's cash flow requirements, current and future tax rates, the amount of available CCA, other deductions that may be available, and the corporation's overall long-term tax strategy. The chessboard illustration perfectly represents this way of thinking. In chess, the strongest players don't focus only on the next move, they think several moves ahead. Professional tax advisors apply the same mindset. Every tax decision is part of a larger strategy designed to maximize the corporation's long-term financial benefit. The key takeaway from this slide is that professional accountants do much more than calculate taxes. They compare multiple strategies, evaluate both immediate and future consequences, and recommend the option that creates the greatest overall tax benefit for the corporation.